1. Start with energy, explain with authority, highlight with emphasis, end with warmth. 34.21 US dollars. That is the number glaring at us from the ticker right now for Supermicro Computer Inc., pushing up by 0.80 cents or roughly 2.38% in today's intraday session. If you are looking at this price on your screen, perhaps through a Fidelity trading platform or glancing at your Robinhood investments dashboard, you might be feeling a sense of confusing déjà vu. Wasn't this stock trading in the hundreds or even above $1,000 just a year or two ago? The expectation for most retail investors who have not followed the granular details of the last 18 months is that Supermicro is a fallen angel, a company that rode the Nvidia wave to the stratosphere, got hit by a short report, and is now crashed back to earth, permanently damaged and essentially over. The prevailing narrative is that the AI hardware trade has moved on to safer names like Dell or HPE, and that SMCI is too wrapped up in accounting drama and margin compression to be touchable. That is the expectation, a broken stock for a broken company. But the reality, the one that is currently playing out in the order books and the supply chains of December 2025, is radically different. The reality is that we are looking at a company that has just completed a 10-for-1 stock split, survived a near-death experience with its auditors, and is sitting on a backlog of orders for Nvidia's Blackwell chips that could potentially double its quarterly revenue in the next 3 months alone. The market is pricing SMCI at $34 because it is looking in the rearview mirror at the governance chaos of late 2024. It is not looking at the windshield, which shows a company that is arguably the only one capable of shipping direct liquid cooling server racks at the scale required by the new gigawatt-class data centers being built right now. This disconnect between the accounting risk discount and the technological monopoly reality is creating one of the most violent risk-reward profiles in the entire NASDAQ. Let's contextualize this intraday move of 2.38%. In a vacuum, a 2% move is standard noise, but for SMCI trading at these levels, it signifies a potential accumulation phase. After the massive volatility we saw following the Q1 fiscal 2026 earnings report in November, where they missed revenue targets significantly, posting $5 billion against an expected $5.8 billion, the stock found a floor. Traders on interactive brokers trading platforms who watch volume-weighted average price, or VWAP, levels have likely noticed that the selling pressure from the institutional exodus has started to dry up. When a stock stops going down on bad news, it is often a signal that the weak hands are gone. The people left holding SMCI at $34 are the ones who have done the math on the fiscal year 2026 revenue guidance of $36 billion. If you divide that revenue by the current market cap, you start to see multiples that look like a value trap, or the bargain of the decade. We need to address the elephant in the room immediately, the trust discount. The reason this stock is trading at $34 instead of $60 or $70 is the hangover from the auditor switch. When Ernst & Young resigned in late 2024, citing governance concerns, it effectively put a "do not touch" label on this stock for every major compliance department on Wall Street. You simply cannot put client money into a company that loses its auditor in the middle of an AI boom. That was the death knell for the momentum trade. However, the reality of 2025 has been a slow, painful reconstruction of that trust. The appointment of BDO as the new auditor and the eventual filing of the delayed 10-K in February 2025 were the first steps. Crucially, the adverse opinion on internal controls over financial reporting was scary to read, but it did not come with a restatement of past financials. This is a critical distinction that many investors using self-investing apps miss. Weak controls means the door was unlocked. Restatement means money was missing. There was no missing money. This suggests that the issue was bureaucratic incompetence, not malice. The market hates incompetence, but it forgives it faster than it forgives fraud. Comment below with Team Dell or Team SMCI to let us know where you stand in the server wars. Do you prefer the safety of the enterprise giant or the raw beta of the liquid cooling specialist? Now, let's talk about the technology, because this is where the expectation versus reality gap is widest. The expectation is that a server is a commodity. You buy a metal box, you put an Nvidia chip in it, you plug it in. If that were true, Dell would crush Supermicro purely on supply chain scale. The reality is that the new Nvidia Blackwell architecture runs so hot that traditional air cooling is physically impossible for dense clusters. You can't just blow fans at these chips anymore. You need liquid. Supermicro's entire business model for the last decade has been built around this specific moment. They didn't just dabble in liquid cooling, they built their entire building block solutions architecture around it. While competitors are retrofitting their air-cooled chassis to handle liquid, SMCI is shipping native liquid-cooled racks. This is why, despite the governance issues, they are still winning orders from the likes of Elon Musk's xAI and other Tier 1 hyperscalers. These customers don't care about who signed the audit opinion, they care about who can deliver 100,000 GPUs that won't melt. The reality is that SMCI's manufacturing capacity for these complex liquid loops is currently higher than the competition's. This is the moat. It is a manufacturing moat, not a software moat. But in a hardware supercycle, manufacturing capacity is king. However, we must look at the Q1 fiscal 2026 numbers again, because they were ugly. A $5 billion revenue print when the guidance was higher is a serious execution failure. It suggests that while they have the capacity, they might be struggling with the components. The delay in Nvidia's Blackwell chips clearly hurt them. SMCI is a just-in-time manufacturer. If the GPU doesn't arrive on Tuesday, the rack doesn't ship on Thursday, and the revenue doesn't get recognized in the quarter. This sensitivity to the supply chain is a double-edged sword. It makes them agile, but it also makes their quarterly revenue lumpy and unpredictable. This unpredictability is poison for algorithmic traders, which explains why the volatility remains so high. Let's shift to the margin profile, which is the other major bear case. Gross margins dropped to around 9.3% in the recent quarter. For a hardware company, that is dangerously thin. The expectation is that as they scale, margins should improve. The reality is that they're in a price war. Dell and HPE are using their massive balance sheets to undercut SMCI on price to steal market share while SMCI is vulnerable. They smell blood. They know SMCI is distracted by legal and accounting fixes, so they're aggressively bidding on enterprise contracts. This is forcing Supermicro to lower prices to keep its customers, which crushes margins. Investors holding this stock in their Schwab Intelligent portfolios need to understand that they are funding a price war. The bet is that SMCI can win on volume, that selling $10 billion worth of servers at 9% margin is better than selling $5 billion at 12%. The stock split psychology is also playing a role here. The 10-for-1 stock split that happened back in October 2024 brought the price down from the hundreds to the 40s and now 30s. This was designed to make the stock more accessible to retail investors using apps like SoFi Invest. And it worked, to an extent. The retail ownership of SMCI is higher now than it was pre-split. But retail money is flighty. It chases heat. When the stock stopped going up every day, retail got bored. The current price action around $34 suggests a base building phase where the bored money has left and the value money is stepping in. We also need to look at the future outlook provided by management. They're guiding for $10 to $11 billion in revenue for the current quarter, Q2 fiscal 2026. Just pause and think about that. They just did $5 billion. Now they say they will do 10. That is a 100% sequential growth rate. If they hit that, the annualized revenue run rate goes to $40 billion. At a market cap of roughly $20 billion, depending on the exact share count post-dilution, that is a price-to-sales ratio of 0.5. For an AI growth stock, that is unheard of. It's pricing for a company that is going out of business. If they actually deliver $10 billion in revenue this quarter, the stock at $34 is arguably one of the most mispriced assets in the sector. But that is a massive if. It requires the